All right, we're about to pull back the curtain on one of the most powerful industries you've probably never really thought about. It's the engine of our sensory world. And from an investor's perspective, this hidden sector has a pretty unique and, I think, really compelling story.
I mean, just think about it for a second. That very specific scent in your laundry detergent, or the exact flavor of your favorite snack, that doesn't just happen by accident. Nope. It's all meticulously crafted by a handful of companies in what we call the flavors and fragrances industry, or F&F. They are, quite literally, the invisible architects of our daily lives.
And you know, this invisible industry is anything but small. We are talking about a market that's projected to be worth over $44 billion by 2030. It is a massive, incredibly resilient, and highly profitable sector that's basically just hiding in plain sight.
Okay, so here's our roadmap for this explainer. First, we're going to define this invisible industry and see why it's basically a fortress. Then, we'll meet the major players, the established leaders, and the turnaround stories. We'll even look at some smaller, specialized companies. And finally, we'll put it all together into an actionable investor playbook.
So first up, let's really understand the bedrock of this industry. Its power comes from one simple fact. It's essential. I mean, think about it. Whether the economy is booming or busting, people are still buying shampoo, soap, and snacks. And that means they are always buying flavors and fragrances.
So the crucial point here for any investor is that this is a non-cyclical sector. What does that mean? Well, it provides these really attractive defensive growth characteristics. Why? Because its products are core components of consumer staples. You know, the everyday items people just can't or won't go without. This creates a remarkably stable and predictable base of revenue.
And on top of that stable base, you've got these powerful, long-term trends just supercharging growth. So you've got rising incomes in emerging markets, which is driving demand for more consumer goods. But what's really fascinating is this massive shift toward natural, organic, and clean label products. Get this, natural ingredients already made up over 74% of the market's revenue back in 2022. So this isn't some small niche, folks. This is the main event.
So how does an industry like this protect itself? Well, it's built like a fortress. The F&F sector isn't just stable, it's also incredibly difficult for new competitors to break into. And for investors, these high barriers to entry are what create durable pricing power and profitability for the companies already inside the walls. The industry is, for all intents and purposes, a classical oligopoly. You have four titans, Givaudan, IFF, DSM-Firmenich, and Symrise, and they control the vast majority of the global market. They set the terms, they drive the innovation, and they are the ones who build the walls of this fortress.
And the walls of this fortress are built on four huge pillars. First, you need massive global scale. Then, you need a gigantic R&D budget just to even compete. We're talking up to 10% of sales poured right back into creating new patented molecules. But the real lock-in, the thing that keeps customers from leaving, is the high switching costs. I mean, for a brand like Coca-Cola, the flavor isn't just an ingredient, it is the product. You can't just swap it out without risking everything. Then, top all that off with a global regulatory maze, and yeah, that fortress is pretty much complete.
Okay, so now that we get the industry, let's look at the titans themselves, because they offer two very, very different types of investment opportunities. You've got the stable, premium-priced leaders, and then you have the cheaper, higher-risk companies that are trying to turn themselves around. So on one side, you have Givaudan. Think of it as the best-in-class operator, the gold standard. It's the market leader in high-margin fragrances, and it has this long history of just consistent, profitable growth. Then on the other side, you have IFF. After a huge merger, it actually became the largest company by revenue, but it's now really struggling with high debt and the massive, massive challenge of integrating all its new businesses.
And the second pair of companies kind of follows a similar pattern. You've got Symrise, which is another high-quality, reliable performer. They're known for their really smart strategy of controlling their own raw material supply, like getting vanilla directly from Madagascar. And then you have DSM-Firmenich, another giant created by a recent merger. It has this unique profile blending F&F with health and nutrition science, but it is also navigating a very, very complex integration.
You know, this slide tells the entire story in just a few numbers. Look at that first data column. That's a key valuation multiple. Basically, what the market is willing to pay for $1 of the company's operating profit. And you can see the market makes you pay a real premium for stability. Givaudan and Symrise traded over 21 and 15 times their profit.
Now compare that to the turnaround stories, IFF and DSM-Firmenich. They're trading at a pretty significant discount. And if you look at the debt column, you can see a big reason why. IFF's high debt load at nearly 4 times its earnings is a huge factor in that discount. The market is very clearly pricing quality versus risk here. But listen, the investment universe isn't just limited to those 4 titans. For investors who are looking for a more targeted bet, there are smaller, specialized companies that offer a pure play on some of the industry's biggest trends.
And a perfect example of this is Robertet. It's a French company that is a pure play on that massive naturals trend we talked about earlier. They have this seed-to-scent model where they control the raw materials from the very beginning, and that gives them this huge advantage in quality and transparency. And with 12% sales growth last year, it's a really compelling story. All right, so let's pull all of this together. Now that we understand the landscape, the key players and their valuations, how does an investor actually approach this sector? How do you play this?
Let's start with the most important question for the cheaper stocks. If you're tempted by those lower valuations of IFF and DSM-Firmenich, what is the one thing, the single biggest risk that could derail the entire investment thesis?
Well, the answer is pretty simple: execution risk. The challenge of integrating 2 massive, complex companies, of delivering on all the promised synergies, selling off the parts that don't fit, and paying down a mountain of debt, it is absolutely monumental. For these 2 companies, that is the entire ballgame. Okay, so this leads us to our first clear investment thesis, which we'll call defensive growth. This path is for the investor who really prioritizes stability and predictability. You'd focus on the premium operators, Givaudan and Symrise, and you'd be accepting that you have to pay a higher price for that quality and, frankly, for that peace of mind.
And thesis number 2 is for the value or turnaround investor. This is a bet on a major comeback from a giant that the market thinks has been mispriced. You'd be looking at IFF and DSM-Firmenich, and you'd be wagering that new management can actually fix the issues. The trade-off here is crystal clear. You are taking on that huge execution risk for the chance of a much, much higher reward.
So, at the end of the day, that's the central question this industry really presents to an investor. It's a choice between 2 very distinct philosophies. Do you pay a premium for the stability of a proven leader? Do you take a calculated risk on the complex transformation of a giant? Or do you maybe seek out a niche specialist to ride a very specific trend? Your answer to that question really defines your path in this fascinating, invisible industry.